Alrighty, well, welcome everybody. This is Juan Loya with Homebridge Financial, and we've got Hugo with the Chicago Deal Vault joining us as well. So thank you for everybody for joining us. We're super excited for today's topic, and really what we're going to talk about today are the financing options that exist for real estate investors. I'm going to give you a little bit about my background as well as Hugo, and then we'll dive in and then show you some fun stuff. So again, my name is Juan with Homebridge Financial. I am a residential mortgage loan officer. I've been a loan officer for about 25 years, give or take a couple of years, I guess. So I've been doing this for a long time, and I am also a real estate investor. So a few years back, I began buying, fixing, selling houses, and we found a fair amount of success in doing that. And then about 2 or 3 years ago, I really transitioned my focus from buying, fixing, and selling to buying, fixing, and building a rental portfolio. Ultimately, my goal is to build enough passive income or enough cash flow that I can, choose to continue doing my day job, which is residential mortgages, or I can choose that I don't need to do residential mortgages when the time is right. So we have really had some really good success in the last year and a half. We've been able to buy, fix, rent, and refinance, and right now we're sitting at about 20 properties, which is starting to generate, a fairly decent monthly cash flow that we're able to reinvest. We're getting about $9,000 a month in passive income or cash flow, which is pretty good in only a year and a half. My only regret is I hadn't started this much earlier in my career. So I'm going to go ahead and share with you, some what I believe are some powerful tips on how to make this happen. So let me see if I can share my screen here. Hugo, are you seeing my screen?
Yes, I'm seeing your screen. You have the ChicagoDealVault website up.
So correct. Now, do you see my screen on how to turn $50,000 into $1 million?
No, I don't. I just see the ChicagoDealVault.
Still the Chicago Deal Vault. All right, let me see here.
At a business with vigilantes and custom thieves.
Any idea how I switch screens?
Why would anyone do random?
Are you using 2 monitors? You might need to put the screen on top of the browser, Chrome.
Well, what if it's not a computer?
Or Explorer.
Yeah, it's in a PowerPoint.
You can make the PowerPoint like maximize the size, like play the presentation.
Keywords and
Let's show. Okay, so if I can, so you're not able to see this screen here, how to turn 50,000?
No.
Wow, all right, that kind of messes with me a little bit. So I guess we'll keep looking at yours, Hugo. Any suggestions on how to fix that?
I'm rather Jimmy's looking to flush out Van Gogh where he can see him.
Yeah, I'm watching.
Okay, how about now?
The Vanguard isn't showing either.
No.
Still the webinar for realtors?
No, we just see your browser.
My browser.
This is ChicagoDealVault.com.
You gotta move in.
Chicago deal. Bear with me, everybody. I apologize.
Well, here, let's check out all these people here.
You want to look at the crowd?
Okay, here we go.
Try something?
Yeah, that'd be fun.
All right, how about now? How to turn 50,000 into $1 million?
Yes, now we see it.
All right, now we get to have some fun.
Perfect.
So, you know, this is something that I've shared with my personal sphere of realtors, and really, you know, a lot of my business that I focus on is helping build my personal realtors investment portfolio, right? So a lot of us, you know, being in mortgages or being in real estate, we don't necessarily have a retirement plan, certainly not a pension or anything like that. That's a thing of the past. So we really have to create something that will continue to feed us long after we decide to stop selling real estate or stop selling mortgages, right? So we put this together, how to turn $50,000 into $1 million. So we begin with the concept of what we call house hacking. Has become a pretty familiar term these days. So anybody who does not own a home or is just getting started, you know, if I was a young realtor in the business or a young person coming out of college, or the children of some of our, you know, of our clients, I would begin with the strategy of house hacking. And house hacking is a way to purchase a property, you know, typically is going to be a 2, 3, 4 unit building where you're able to purchase the property, get traditional financing, and you're able to have your tenants pay most or all of your mortgage, right? So one of the recommendations that I typically make is, you know, buy a property that's going to need some repairs, you know, so a typical program might be an FHA 203K where you can buy a property, fix it up, create some equity, and then rent it for, you know, top dollar because now it's been an updated property. You can rent it and receive higher rents, and hopefully those rents will pay for most, if not all, of your current mortgage payments. Now, by doing that, what we're able to do is really set the foundation for your real estate investing. Because real estate investing, you know, we have to kind of get your personal home in order first. We want to get your housing ratios, your debt to income ratios, get your personal cost of living as low as possible, because that will allow us to start to build on that foundation, which is, you know, rental income or cash flow properties. So I like to say that anybody who does not own a home today, they have the golden ticket. They can start it right, which is going to be with a multi-unit property, live in one, rent out the others. You know, for those condo buyers, I like to say, why buy the condo when you can buy the building, right? So how to finance these real estate properties or these investment properties that we speak of. So there's kind of a spectrum of financing that is available, and you know, it starts with residential financing. Residential financing is going to be your Fannie Mae, Freddie Mac, FHA, your agency type financing, where you know, it's a very liquid market. I, as a lender, am able to write a loan and basically get that sold off to the secondary market. Eventually, these loans end up, you know, at Wall Street, right? This is the traditional form of lending, Fannie, Freddie, FHA. The next level of financing that exists is what we call portfolio financing. And portfolio financing might be, you know, there's hedge funds out in the marketplace that are relatively liquid, that they're able to write loans or buy loans that are written to their guidelines. So when we do an agency loan, or Fannie Freddie FHA loan, what we're doing is we are writing loans that meet those agency guidelines, so Fannie Mae guidelines. A portfolio lender is basically able to create their own guidelines, so they have their own money and they say we're going to lend money and buy loans that meet these particular criteria. Now, these lenders are not necessarily focused on, they're not looking to sell these loans off into the secondary market. They already have a group, like a hedge fund, private investors that have put this money together, and they could potentially package up and sell it into bonds. Still relatively liquid, but they're coming up with their own rules. Now, the thing about that is there's going to be some additional flexibility from what you would experience in the Fannie and Freddie Mac type of world. The portfolio lending, they come up with their own rules, and they still have pretty competitive rates and fees. Commercial financing is going to be similar to a portfolio financing, but the thing about commercial financing is the commercial lenders, many times you think of commercial and you think, oh, it's got to be a super big building, or it's got to be a storefront or strip malls or truly a commercial building. We're able to use commercial financing, and really what it is commercial financing will lend to a corporate structure. So commercial financing will not lend to you as an individual, but they will lend to your LLC or to your S corporation or C corp. Some sort of corporate structure is required for these commercial lenders to lend to you. Now, the biggest difference here is really the amount of time that the commercial lenders need in order to be able to foreclose and take a property. When the reason commercial lenders will not lend to you on a personal level, it's mostly because personal foreclosures, in the state of Illinois, is somewhere between probably 12 to 30 month process, depending on the lender and how good they are. But typically a foreclosure in Illinois is going to be over a year if it's in your personal name. If it's in your corporate name, your LLC or your S corp, the commercial lenders can foreclose and get that property back probably within 60 to 90 days. So they're much more flexible, but they are going to have the ability to get that property back if you were to default on it. Now, commercial is also going to be synonymous or very similar to the term hard money financing. And hard money lenders are really going to be a very short period of time that the hard money lenders are going to lend you money to buy it, fix it, and sell it, or buy it, fix it, and be able to refinance it to put it into a long-term loan. So the hard money lenders, they have quite a bit of flexibility. It's mostly going to be focused on the asset, so the project itself, versus you as the borrower. So they're more interested in what is the value of the home. They're more interested in the condition of the home or the property versus your personal income, right? So the thing about hard money lending is, many times you're going to be paying 2-3 points and a 12, 13, 16% rate. That I've seen some of these hard money lenders, and I would suggest don't get overly fixated on the rates and fees. If the loan is only for 3, 4, or 6 months, if it achieves what it is that you're looking to do, which is build your portfolio, paying a slightly higher interest rate for a short period of time is not bad, as long as you keep the long-term strategy in mind. Now, but again, you don't really want to carry hard money loans longer than 6, 9, or maybe even 12 months, depending on the size and scope of your project. The next type of lending would be what we refer to as private capital. And private capital is really, private capital is the type of money that you get at your Thanksgiving, day table. So, when you're borrowing, personal, or not personal loans, but private loans from mom, dad, brother, sister, your uncles, it's really a relationship type of lending. And, private capital is great because, it's really based more on your personal relationship and on your personal experience than any other type of lending. Now, if you have good private capital sources, you can have a great deal of flexibility, and you can structure the transactions or the deals in whatever works for you and that private lender. So, again, if you were borrowing money from a relative, what kind of terms are you able to negotiate with them? Something that gives you flexibility and something that gives them enough revenue to make it interesting for them to want to take money out of their self-directed IRA or their personal funds to be able to do that. The next way to finance a project would be a joint venture. So, a joint venture might be something where, you have a great deal, a great house that you can buy, fix, and sell, or buy, fix, rent, and you find a partner that wants to do it with you. So, again, maybe some relatives or some friends who are sitting on a whole lot of money, but they don't have experience in flipping properties, or they're really, they like the concept, but they don't really want to be involved on a daily or weekly basis, and they're willing to partner with you. Now, again, when you start to look at things, there's a balancing act between all of this, because you might say, well, paying 2 or 3 points and a 12% interest rate, although that seems high, when you do a joint venture with somebody and you give them half the profit, that could be even more expensive than just paying for hard money or private capital. So you have to balance the two out. But there's also, in a joint venture, you're not necessarily assuming all of the risk. You're spreading that risk between you and your joint venture partners. And then the other way, kind of crazy way to finance some of these properties is just cash. If you're sitting on a whole lot of money in the bank, you sold the property and you want to invest into others, just kind of a crazy thought is you just outright buy it cash. Now, typically not something that Hugo and I would really be advocating, because we're really more in the belief of find ways to use other people's money to build your investment portfolio. So just some highlights on that. Now, as we move forward, if anybody is interested in this investment property analysis, here is my contact information. Just shoot me a quick text and I can forward you this spreadsheet that I'm going to go through here in a minute. You can text me at 708-945-6424. So this is just a very basic investment analysis sheet that I had put together. But at the end of this, I'm really going to show you that in working with Hugo in the DealVault, you won't really need this. You'll have much better tools available. But the concept, the basic premise or the basic concept of this is to be able to buy, fix, and build a portfolio with relatively little cash and be able to recycle your money back out of that deal. So let me give you an example. So we're going to be talking about a small little purchase of, say, $80,000. We want to put maybe $30,000 in rehab or upgrades into this property. So our acquisition and rehab is $110,000. If you were to put 20% down, that's a $22,000 down payment. We're going to finance $88,000. Now, as we're done with that project, we're going to go back and look at it and say, okay, we financed $88,000. We invested $22,000. That was, again, it's $110,000 invested. plus some transactional costs. So whatever type of financing you decide to put together between your points and fees and title and all of the expenses that you might have, we'll call it $10,000 in transactional costs. That's a big number with a total all in at $120,000. Now, when we're looking at this, if we were to finance $120,000 on a residential interest rate, that would get at a 5% interest rate on a residential mortgage. That would be $537. We're assuming $417 in monthly real estate taxes, $83 a month in homeowners insurance or property insurance, a total monthly payment including taxes and insurance of $1,037. Now, the goal here is this property that you bought and fixed and borrowed $120,000. The goal here is that once you fix up that property, we can get an appraisal on that property, which is our after repair value, is going to come in at $160,000. So we're looking for houses that are worth $160,000 or better, and we know that we can finance 75% of the after repair value. We're able to finance $120,000 minus our total acquisition and rehab cost of $120,000. So literally, we've got no money invested into this property. So we were able to buy it and fix it, plus our transactional costs of $120,000. And at the end of the day, we know it's worth $160,000. At 75%, we're able to borrow $120,000. So literally, we don't have any money invested into this project. Now, the after repair rent on this home, we're estimating a rental income of $1,600 a month, minus our total payment of including principal, interest, taxes, insurance of $1,037, which gives us a net monthly cash flow of $563 a month. So the question that we ask is, if you can buy, fix, and rent this property and have no money of your own invested in this home once that transaction is complete or once that property has been stabilized, if you can have no money invested and make $563 a month, would you consider that to be a good deal? The options are yes or yes, right? I mean, I think everybody that I poll would agree that that's a great scenario, is to have no money invested and make $563 a month, right? Hugo, do you agree with that? I lost Hugo.
Absolutely. Okay. No, I'm here. Absolutely. That's right. The way to grow exponentially, to have very little money down or zero money down, like the example that you shared, so that we leverage from other people's money and be able to grow, just replicating the same approach as you showed on this example.
Exactly. So just going to click real quick through some of these assumptions. Again, we were estimating $5,000 a year in taxes, $1,000 in homeowners insurance. We have a little bit of repairs and maintenance built into those numbers. But as we kind of go through this quickly, just estimating what our total expenses would be. So, the comments here is the goal is to create value add transactions, right? We're not just out looking to purchase properties. We're looking to purchase properties, purchase the property at a discount due to property conditions, increase the value through property renovation. So, again, it's hard to find just really great deals. Typically, you have to fix it up a little bit to increase that value. Complete the refinance of up to 75% after repair value with the goal of recapitalizing all or most of your initial transactional investment. And then the next part is rinse and repeat. If we can do it one time, why not continue to do it over and over? Again, as we mentioned, we want to borrow the money in the best possible way, depending on, where your personal financial situation is, whether you can qualify for residential financing or portfolio lending, hard money, commercial, private capital, joint ventures, or cash, however you want. And then at the end, you refinance and take it back out. So we put together a the next part of this is if we can do that one time, the question becomes how quickly or how fast can we accelerate through this? So then we want to use what we call a snowball effect to pay these properties down. And the goal in this example is to have 7 properties paid off within 10 to 12 years, or have 10 properties paid off within 15 years. And let me show you how doable that is. So my question is, my statement, how to borrow $1 million and have other people pay it for you, right? So here's an example of if we were to have these 10 properties where we owe $120,000 on every property, so we would owe $1,200,000. If every one of these properties, we can't really see it here. Okay, so here. So if we were to owe $120,000 times 10 properties, and they're worth $160,000 times 10 properties, so very easily we can see that we created $400,000 in instant equity, which is the difference between what we really owe on it and what it's worth in today's market. So to begin with, if we did it 10 times, we created $400,000 in net equity. Or asset value. That's a pretty good start to creating your $1 million net worth, right? So as we start to pay these properties down, the goal is to really take that extra money that you have every month, which is your cash flow. If you were to take all of the cash flow from all 10 properties, so in this particular example, we're assuming that there's about $400 a month in net income or positive cash flow from every property. If you were to take the positive cash flow from all 10 properties, you would get $4,000 a month that you would use to apply towards your principal balance. And we would take that and we would apply all of the money to property number 1 first. And what would happen if we were applying that $4,000 a month in positive cash flow to property number 1, we would actually pay that property off in as little as 28 months. So if we started, if we started today, in May of 2022, we would have our first property paid off. And then with the money that you are no longer paying on that first mortgage, we take that additional money and we apply it to the second property, right? So now property number 2 is actually paid off in 53 months. Now you can see the difference. The first property took 28 months to pay off, and the second property, so if I say 53 minus 28, the second property only takes 25 months to pay off, because we're taking that extra money and paying off the second. So if we continue through that cycle, what we're able to see that in property number 7 would actually be paid off in 144 months. So again, we say 144 divided by 12, which is 12 months a year. So basically, property number 7 would be paid off. You would have 7 properties paid off within 12 years. And here, if we continue the cycle, once you have 8 properties paid off or 9 properties paid off, the 10th property, the difference between property number 9 and 10 is a difference of only 12 months. When you're generating that much cash flow, you could literally pay off a property in only 1 more year because you have all of that free money. Now, again, this is an example of if you were to build a portfolio of 10 properties. Now, those 10 properties today we said are worth $1.6 million or $160,000 per property times 10. And we're showing you that if you were to have some discipline and use all of that cash flow to pay down this debt using the snowball effect, the bottom line is in roughly 15 years, you would have all 10 properties paid off free and clear. And if today they're worth $1.6 million, I don't think it's that unreasonable to assume that in 15 years, those properties could potentially be worth $2 million, $2.5 million, $3 million, and they are free and clear. So I always tend to use the thinking of my money should double every 7 years. So if they're worth $1.6 million today, and if they were the opportunity to double every 7 years, that capital should have doubled 2 times in the next 15 years. Boy, I'd be very surprised if that portfolio is not worth at least $2.5 to $3 million in 15 years, and they're all paid off free and clear. Hugo, does that make sense? Do you see the power of that?
Absolutely, Juan. Absolutely. I mean, it's extremely powerful. Trying to pay down those remaining properties. So I guess the key is to be very strict as to utilizing that cash flow to pay down the principal on the remaining properties.
Correct. So, again, as I created this spreadsheet to demonstrate it, right now the interesting part is my personal portfolio in the last, 2 years. I'm currently sitting on about 20 properties, right? So imagine how fast that we're able to pay these properties down when we're getting that type of massive cash flow. Make sense?
Absolutely. No, that's incredible. And especially the fact that you started not too long ago. We're talking about probably 2 years.
Right, correct. In less than 2 years, we built that up to 20 properties. So, again, this is, again, and I put this spreadsheet together because, again, we talk a lot about these theories, Hugo, but I think this is pretty powerful to actually see how quickly you could pay these properties off, because we talk about it, but until you actually look at it, you're like, wow, this actually does work, right? And the reality is, math is math, right? You can't, we're just following the numbers, and it's so powerful, it's incredible, right? So, if anybody, so this is kind of a similar way to show it, but it's pretty much the same information. If anybody is interested in receiving that spreadsheet, again, just text me. There's my number. I'll leave it on the screen for just a few minutes. Text me to 708-945-6424 that you want that spreadsheet, and I can get that sent out to you. So the next thing that we really want to talk about is the power of the Chicago Deal Vault. So the Deal Vault is a platform that Hugo has put together. Hugo and I, both being real estate investors and both, being part of, other organizations that have taught this type of strategy. Again, we both studied at Chicago REIA with Andrew Holmes and in the Mastery Group. So Hugo's a pretty smart guy, and what he did is he basically took all the fundamentals that we learned within our Mastery program, and what he did is he compiled, or he put together this platform, this software that really allows us to analyze deals very quickly. And what the Deal Vault does is, I'm going to switch screens here for a second, Hugo. Let me see what I can do. Log in. Bear with me. Share. Okay, so hopefully you're able to see. Hugo, are you able to see my screen here? My Chicago Deal Vault?
Yes, I am.
Okay, so I'm getting better at this. Let me just switch the screens. Are you still able to see that? Or what are you looking at? You looking at my Facebook?
Correct. Yeah, it's a house, a building, in Facebook.
No, nobody wants to see that, right? So let me bear with me a second. Share. Okay, here we go. All right. So are we looking at my Deal Vault?
Correct.
Right. Okay. So what the DealVault does is it's a software, a technology that Hugo put together to be able to analyze properties pretty quickly. Now, this particular call is directed at our real estate friends, directed for real estate brokers, right? So many of you are working with clients, and many of you, also want to be investors, right? So, and we strongly advocate that that everybody in real estate should be investors themselves. So what the DealVault does, it enables us to quickly analyze information. So we're able to get information straight from the MLS, right? So the same typical information that you get on your MLS, we're able to get it through the DealVault. Now, the difference is you would say, well, why on earth do I need to get this if I'm already on the MLS? Well, the reality is what we want to do is we want to empower you to share this technology with your investor clients so that they can do the same powerful searches, and they're not necessarily taking up a lot of your time as they're looking for great deals. So we're able to get access to MLS just like you as a real estate broker, but we're also able to get access to probates, to pre-foreclosures, to upcoming auctions, bank-owned properties or shadow inventory, vacant properties, as well as wholesale deals. So, again, my job as an investor is, I'm out looking for the best possible deals that I can get, not necessarily just what is already listed on the MLS. So what the DealVault does is one of my favorite, I've got this little button here in the middle. One of my favorite things that I focus on is really upcoming auctions, okay? So upcoming auctions might be like what you refer to as your share of sales, right, your foreclosure sales. So, again, if I were to look just in Cook County, upcoming auctions in Cook County would give me access to roughly 1,655 properties are coming up for auctions in the next 90 days in Cook County. Right now, that's an awful lot of properties to go through. So, one of the things that I might say, well, as an investor, where am I interested in investing? Well, if I'm an investor, I'm going to use some of my favorites like, LSEP, right? So I want to look for LSEP, I want to look for Oak Lawn, and, maybe I want to look for Burbank, right? As an investor, if I could buy some properties in that marketplace, so LSEP, Burbank, and Oak Lawn in a very quick, few keystrokes, I'm able to determine that there's 38 properties that are coming up for share of sale auction in the next 90 days in those 3 towns, right? So as an investor, this gives me a great opportunity to pick up some awesome deals. Now, if I really wanted to narrow this down even further, I said, you know what, Hugo, I only want to focus on properties that have decent equity. I want a lot of equity in these houses so that I can negotiate a great relocation package for the seller, buy the house, help them get some money to move, move along quickly, and everybody's happy. So I'm just going to click this extra little button that says only show me properties at 50 to 100% equity. And hey, guess what? I hit search again. And out of those 1,655 properties, and then out of those 38 properties that are in these towns, now it tells me, look, here's the 4 houses that have at least 50% equity in these homes, and I'm able to very quickly make that determination. Now, here's let's organize them by the highest equity first. Hey, wait a minute, here's a property at 9812 South Moody in Oak Lawn that has an auction day. Oh, guess what, Hugo? That auction was today, right? That auction was today, January 14th. They owed $98,300, and we're estimating that property is worth $245,000 with $146,000 in equity. imagine if we were to have talked to these folks a week ago, 2 weeks ago, and said, hey, listen, we can get you a nice relocation package. And you know, even if we were to have, you know, given them $20,000, $30,000, $40,000, we're able to buy a house with a ton of equity, and that would have been a great deal. Now let's take a peek here. If I were to look at this house and say, hey, let's check it out. Maybe it was on the MLS, and if it was on the MLS, I'll get a little bit of extra information here. Let's see if we can, oh, look at that. So this property, I'd have to see when it had been sold, so let's see. So it was last on the market on September 4th, 2014, and as an investor, wouldn't I love to be able to buy this house today for you know, knowing that they owed $98,000. Imagine if we could have gone and bought this house for, you know, our number here is if I was looking to flip this house, I should be buying it for $116,000. So again, maybe I could have given them $10,000, $15,000 for the sellers to walk, right? If I was keeping it as a rental, the system tells me I should be buying it for $139,000. So again, there could have been a great opportunity here if I could have gotten access to this information much sooner, right? And so as we look at this, imagine a system that on some of these houses, we're able to get that skip tracing information, and the system will actually tell us, give us the seller's phone number so that we can actually pick up the phone and say, hey, Mr. or Mrs. Seller or Mr. or Mrs. Homeowner, I'm a local real estate investor. I'm looking to purchase properties in your area. Now here for this second property, look, guess what? Here are the you know, 6 or 8 different properties that might here's the 6 or 8 properties that might or 6 or 8 phone numbers that might be tied to that homeowner. And now we can give them a call and say, hey, here's a great opportunity that, you know, we'd like to give you a relocation package. Because the thing is, we know they have to leave. They, you know, again, the sheriff sale is in a week. Sheriff sale is in 2 weeks. It's not like they can hide from this anymore. They've got to go, and we just want to be here to try to put that offer together, right? So this is the sheriff sale part of it, or the auction part. You can also do that with, you know, with pre-foreclosures. We can do that with probates, vacant homes, bank-owned properties, a lot of different opportunities there. So the other thing, remember, Hugo, I'm gonna steal from you. I said, remember, friends, because you love to say friends. Remember, friends, when I showed you that one of the ways to purchase these properties is with cash or joint ventures or private capital. Imagine if you had access to a list of people that have actually lent money to private parties. Here's our list of cash buyers list, that there's 62,000 people in the Chicagoland market who have actually done private loans, right? And then we can actually break this down and say, hey, you know what, I'm most interested in dealing with people who have done a lot of private loans. So if you're trying to be a real estate investor, or you're trying to partner your clients with private, you know, capital, now you're able to sort through this list and come up with people who have actually done private lending, and, you know, go see if they're interested in doing some more, right? So the DealVault is a fantastic opportunity to give you leverage, give you back some of your time, and our goal is to give you guys, the real estate brokers, the tools to actually be able to work with your clients so that your clients can put in the work, and then at the end of the day tell you which houses they want to make offers on. So then, you know, then you get to go make a living, which is making offers. So by the way, right here you can see the number of private loans that have been done. So these particular people have done over 200 private loans within the Chicagoland market. Wow, do you think these folks have some money? Maybe you could get on their private lending list, right? So, so what we've done again is really partnered up with the DealVault. I said, Hugo, I have a lot of friends who are realtors in the Chicagoland market, and what I wanted to do was really get this powerful tool to my realtors so that they can get this to their clients. And so one of the things that as we get your clients using this platform, and we're gonna help train your clients. There's a whole bunch of training videos and everything that not everything, but a lot of what Hugo and I went and learned has been turned into training videos that we're able to share with you, and more importantly, able to share with your clients. So wouldn't it be great that if you're actually working with educated clients so that they're not wasting a lot of your time on simple, trivial questions, why not have them go through the training so that you can have a more educated dialogue with them? Now, once somebody finds a property that they like, Hugo, do you have a property address in your head?
4722 South Kedville.
So let's say 4722 South Kedville, and one of the greatest things here is we'll pull up this property real quick. So here's a property that, let's just say I had my eyes on this house, right? And the platform is telling me, hey, you know what? Fixed up, this house should be worth between $224,000 to $248,000. So this is part of their system here, right? Telling us 224 to 248. Hey, guess what? This house actually sold at $230,000. So right in the middle of that ARV range that the DealVault had come up with. Now, the DealVault is basically telling us that based on the square footage of this property, the rehab cost should be between $19,000 and $29,000, giving us a net profit of about $37,000, $38,000. So if somebody were to buy this property and say, hey, you know what, I think this property can sell between $224,000 to $248,000. I think the property could sell for $230,000, and then it's going to cost me $30,000 to fix it up. Right here, the system is telling us that if you're going to flip this property, you should be offering no more than $142,000 to buy this house. So the idea here is, as your client comes here and says, you know what, I want to see the comps. The client can come in here and say, show me the comps that justify this property. What is this property going to be worth? And we want to see 6 months back. So we open up the parameters just a little bit. Let's take a look at some of this data. And here the client is able to start to look at, it's not so much you guys telling the clients what you think the house is worth. It's let them start to look at this, and they can, add or subtract, and they say, hey, this looks like my house, or it doesn't look like my house. And again, oops, where'd it go? Here we go. So there's, no, I don't really think that one looks like my house, so let me eliminate that from the comps. And what's going to happen is right here, the system is saying it's got an ARV of 229, but if I get rid of this comp and I get rid of this comp, it's going to recalculate it for us, and now it says it's got an ARV of 244. Okay, so the client can kind of pick and choose what comps they agree with or disagree with, and then at the end of the day, you're able to right here, the client can say, make an offer, and it's going to generate a 7 point. So again, if I say, hey, I need to buy this at 142,500, and what would end up happening is I put in a little bit of information, I hit submit offer, and what's going to happen is it's going to create the 7.0 contract. Here is my offer, and kind of the greatest part about this is this particular contract will be emailed to you as the realtor, so that now you've already got that contract in your hand and you can get started doing what you do best, which is negotiating, not necessarily regurgitating information which is already out there. So if you have an educated investor, their job is to find great deals, and they're up. So here you see right here is that, hey, great news, a contract was just generated, and that would have been sent to, please be so kind to submit the attached offer, and I'm sending that to my realtor on file, right? So you as a realtor now are able to leverage your investors' time, let them spend as much time on the DealVault as they like, give them the powerful tools that already exist, and now they're identifying those great deals, telling you, hey, Hugo, I want you to make an offer on this property, 123 Main Street. Here's my educated decision as to why I think, that 142 makes sense. But again, this is a numbers game. The more offers you present, the more offers you get accepted. The more houses they buy, the more houses they fix, the more properties they bring you back to list fixed up. Or you know what, if they're building a portfolio, now you can pick up some additional revenue by helping them either manage those properties or helping them get those properties rented, pick up some rental commissions. And again, there's a whole different genre of ways that you can get paid. So Hugo, hopefully I gave a fair description to what we can do with the DealVault, and this has been one of my critical tools that I have used to be able to build my portfolio in a short period of time from 0 to 20 properties, simply by using these tools that have been put together for us. So anything that I missed or that you'd like to add?
No, it was great, Juan. Thank you. You covered pretty much the most important items from DealVault, especially how we can add value to the realtors' clients, not only for them but also for you guys, realtors, because then you can increase your sales commission revenue. So it's a win-win for everyone. We're gonna take on some of the overhead and that you incur right now to free up some of your time as brokers, so that you can work with more clients, you can do things that you truly like, but at the same time without compromising your sales commission, because we're gonna train one-on-one your clients for them to fully understand and be able to send offers your way for you to negotiate.
Right. So one of the things that, again, when I spoke to Hugo and I said, this is such a powerful tool, I have to share it with my friends who are the real estate brokers. And, again, I wanted to offer the best that we could offer to you guys. And Hugo has generously agreed to this. We had it might have taken a couple of nice dinners and a couple of cocktails, but we all agreed, right, Hugo? So what we've been able to do is really come up with a discounted platform for you as licensed real estate brokers. And normally this platform, normally the Chicago DealVault is an investment of $190 a month, okay? But because you are real estate brokers, Hugo has agreed to lower that cost for anybody who listened on today's webinar. He's agreed to lower that to an investment of only $140 a month. Now, if our goal is really to get this platform in the hands of your clients or your investors, if you would. So the goal here is that any broker who has 2 or more investors signed up or 2 or more users signed up, your monthly fee would be waived. So this is free to you as long as you have 2 investors who are subscribed to the system. So the goal here was to get you this powerful technology, to be able to share this with your investors, to let the DealVault staff train your investors or educate your investors on how to use it, and then ultimately get them writing more offers, because the only way this works is for them to write more offers. Again, where do I come in? I am a residential mortgage lender. My goal is to either help your clients get their financing up front or help your clients do their takeout lending, but ultimately this is going to create a whole lot of extra activity, right? So again, what we're going to do is share that offer with you, that if you again, if you are a licensed real estate broker, it's $140 a month, and if you have 2 or more investors using it, it is at no cost to you, right? So I do have a hand raised. I'm going to unmute Anthony real quick. Anthony, can you hear us?
Yes, I can hear you.
Yeah, what you raised your hand, you had a question?
Yes, I was just wondering, is this only for licensed realtors, or can like wholesalers join in too?
Again, this is definitely a platform that is good for wholesalers. Now, again, with the new law, wholesalers, you should be licensed as a real estate broker if you're a wholesaler. But yeah, the offer of adding 2 clients would really be if you're a broker, but this is still a great investment. If you're a real estate wholesaler, you should be using this platform.